January 2025. Wall Street's top analysts released their carefully selected stock picks for the year. Blue chips, diversified, safe. By December, they were down 8%. That same month, a group of anonymous Reddit users closed out a $10 million portfolio, up 76%. And the financial media hasn't said a word. This is the WallStreetBets 2025 index. 10 stocks, equal weight, no rebalancing. Built by the same community that broke GameStop and forced billionaires to explain short squeezes on live television. The same people institutional investors called reckless gamblers. The same platform CNBC mocked as a meme stock casino. They just beat the professionals by 60 percentage points, tripled the S&P 500, crushed every major hedge fund. And here's the part nobody wants to talk about. It wasn't luck. The 2026 portfolio launched 3 weeks ago. 10 new stocks. Same structure, same conviction. But the market conditions that made them rich, those are gone. Here's what actually happened. January 1st, 2025. While Wall Street analysts were hedging their picks with disclaimers, WallStreetBets posted a challenge. 10 stocks, hold for 12 months. See what breaks. The rules were simple. $10 million split equally. No selling, no rebalancing. Just conviction and catastrophically high risk tolerance. The lineup dropped. AST SpaceMobile, Rocket Lab, Google, Amazon, Nova Bay Biosciences, Reddit itself, Micron Technology, Iris Energy, Tesla, Palantir. Wall Street's immediate reaction? Laughter. Look at this list. 3 are household names. 7 are companies your financial advisor has never heard of. 2 are space stocks with barely any revenue. 1 is a pharmaceutical penny stock. Another is a crypto mining operation that tracks Bitcoin's volatility. Too concentrated, too speculative, no dividend protection, the kind of portfolio that gets you fired from a risk management meeting. But here's what the professionals missed. This wasn't gambling. This was structure disguised as chaos. Starts with the space stocks. AST SpaceMobile wasn't just another speculative play. They're building the first space-based cellular network. Direct-to-phone satellite coverage. No towers, no ground infrastructure. Partnerships already signed with AT&T and Verizon. January price, $14. December price, $47, up 241%. Rocket Lab followed the same trajectory. While everyone obsessed over SpaceX's private valuation, Rocket Lab quietly became the second most active orbital launch provider in the world, launching every 2 weeks, building satellites, capturing market share. SpaceX can't monetize because they're not public. January, $4 a share. December, $27, up 542%. Now here's where it gets interesting. These weren't lucky bets on hype. These were calculated positions on infrastructure that doesn't exist yet, but will eventually have to. The kind of asymmetric risk professional fund managers legally cannot justify to their compliance departments. Even if the thesis is sound, even if the math works, they can't touch it. Retail can. Then there's the boring middle. Google, Amazon, Tesla, the safe picks. The ones that gave the whole portfolio just enough credibility to avoid being dismissed as pure speculation. Google returned 18%, Amazon 24%. Solid, predictable, exactly what they were supposed to do. But here's the real story. Those stable positions weren't there to make money. They were there to provide a floor. With 3 megacap stocks anchoring the portfolio, the entire structure could absorb catastrophic losses on the speculative bets without imploding. That's not Reddit chaos. That's a barbell strategy. Stable core. Explosive edges. The same approach venture capital funds use when they know 9 out of 10 bets might fail, but the 10th will return 100 times. And it gets better. The portfolio had losses. Nova Bay Biosciences, the pharmaceutical penny stock, down 16%. Iris Energy, the crypto miner, tanked with Bitcoin. These positions failed, but they knew going in that 4 or 5 stocks might go to zero. The structure was designed so 2 or 3 massive winners would more than compensate. That's how early stage investing actually works. It just usually happens behind closed doors with accredited investors writing seven-figure checks, not in a public subreddit where 2 million people are watching in real time. December 31st. Final numbers. WallStreetBets index up 76%. S&P 500 up 23%. ARK Innovation ETF, the professionally managed fund full of PhDs holding similar high-growth names, up 12%. Reddit beat the market by 53 percentage points, beat the professional growth investors by 64, with a portfolio so concentrated it would violate every institutional risk policy in existence. So here's the question nobody in the financial media wants to answer. How? The first mistake Wall Street made was assuming this was random, some kind of meme-driven lottery that happened to pay off. It wasn't. The community didn't just pick stocks and hope. They ran analysis, thousands of users stress-testing assumptions, posting counter-arguments, challenging every thesis. Crowdsourced due diligence at a scale no single analyst team could replicate. What looked like chaos from the outside was actually coordination at a level most institutions can't achieve. The second error? Underestimating conviction. Professional fund managers have careers to protect, reputations to maintain, quarterly reports to justify. They can't afford to be wrong in an interesting way. Being wrong in a boring way? Losing 8% in a down market while holding blue chip stocks? That's explainable. That's acceptable. That keeps your job. Retail investors playing with their own money had no such constraint. They could be spectacularly wrong. But if they were right, the upside wasn't a year-end bonus. It was generational wealth. That asymmetry changes everything. And here's the part that should terrify Wall Street. Timing. The professionals made their 2025 picks in December 2024, based on macro forecasts, interest rate predictions, what looked safest given the uncertainty. WallStreetBets made their picks in January 2025, after seeing how the year actually started, after watching the first week of price action. 1 month difference. Completely different information set. Then there's the narrative advantage. AST SpaceMobile and Rocket Lab weren't just good companies with solid fundamentals. They were good stories. And in modern markets, stories drive price action faster than earnings reports. By the time those stories hit CNBC, the gains were already made. Which brings us to the mistake retail investors made. The ones who saw AST SpaceMobile on the front page in November, bought at $40, expected it to hit $100. They're sitting on losses now. That's the pattern. The community builds conviction early. The thesis plays out. Media coverage brings in the late money. Early believers take profits, and the late arrivals hold the bag. It happens every single cycle, and it's about to happen again. Because here's what nobody's saying out loud. The WallStreetBets index didn't beat Wall Street because they're smarter. They beat Wall Street because they're playing a different game with different rules. Institutional money has regulatory constraints, fiduciary duties, redemption risk, legal liability. They cannot put 20% of a fund into a space stock with 4 quarters of revenue, even if the math works, even if the thesis is sound. They structurally cannot do it. Retail can. And in a market that rewards concentration and conviction over diversification and caution, that's a structural advantage that compounds. But there's a darker side to this story. The 2025 index worked because we were in a bull market. Space stocks rallied because risk appetite was high. Speculative growth outperformed because liquidity was abundant. Investors were willing to pay for narratives, not just earnings. The 2026 index is launching into completely different conditions. Interest rates are higher. Valuations are stretched. Liquidity is tighter. The same bets that worked last year could easily collapse this year. Not because the thesis changed, but because the market regime did. And here's the risk nobody wants to acknowledge. The 2025 success brought in new money. Copycats. People who don't understand why the original positions were chosen. They just know it made money. So they're copying the structure without understanding the context. That's not conviction. That's FOMO. And that's exactly how bubbles start. 3 things here that matter beyond Reddit and meme stocks. First, concentration beats diversification when you actually have an edge. The traditional advice to own 30 stocks assumes you know nothing special about any of them. If you genuinely understand something the market doesn't, concentration is how you capitalize. But you better be right. Second, structure determines outcomes more than selection. The WallStreetBets index wasn't 10 random stocks. It had a barbell, stable core, explosive edges. That's legitimate portfolio construction. The memes and rocket emojis hid the math, but the math was there. Third, timing matters more than the idea. Every single position in that 2025 portfolio could be fundamentally correct long-term and still lose money short-term if macro conditions shift. Knowing what to buy is half the equation. Knowing when to buy it is the other half. And the lesson most people won't learn. Past performance means nothing. The 2026 index could be down 30% by December. Same process, same conviction, same community, different market. That's the part that doesn't make headlines. Wall Street spent all of 2025 explaining why retail investors don't understand risk. Retail spent all of 2025 outperforming Wall Street by 60 percentage points. The 2026 index is already live. The positions are public. The thesis is documented. And the professionals still aren't talking about it. Whether it works again? That's a different question entirely.